Before I go into commercial conversions, I want to tell you about this newsletter. It's called the Tax Wise Property Investors Newsletter, dedicated to property investors, and it covers a lot of valuable content in terms of taxation. So in this particular edition here, we've got the 5% VAT rate and how that works on building works. We cover the higher rate SDLT on mixed use properties and how that works. We've got information about the tax return deadline, because that is quite topical right now. We've got the pros and cons of using a property company, and covering quite a lot here, by the way. Then I've got an article here on can property owners claim inheritance tax business property relief. That's quite detailed. Got a section here on director and shareholder loans to fund property purchases. Another section on investing in your own commercial property, and that talks all about how to use a SAS and how to make it tax efficient. So you can see a lot of content in this newsletter. If you want to subscribe to it, there'll be a link posted beneath this video. Click that link, you get the first month's free, so you can test it, read it, look at it, see how you find it, and if you like it, you can then subscribe to it. You won't regret it, trust me. Okay, commercial conversions, which by far, in my opinion, is one of the best property strategies and my most favorite property strategies. You can tell that if you spend more than 15-20 minutes on this particular channel, you'll see my projects, and the majority of which are commercial conversions. So if you're new to commercial conversions, you haven't heard of commercial conversions, what are commercial conversions? Very simply speaking, this is when people buy commercial property and they develop it either fully or partially into residential property. And this can be property like offices, pubs, shops, warehouses, which then get converted into residential property. So how do you get started in commercial conversions is what you might be thinking. It's good to know in advance the kind of properties that you are looking to convert, or you're interested in looking to convert, and then obviously think about whether you want flats, apartments, studios, HMOs, and which one you have a preference towards, or which one you think works well, or which one you know a lot about. It could be that you're looking to buy a pub and convert it into an HMO. Sometimes that has its own challenges in terms of camera and how they might lobby to keep a particular pub from being converted, but that's something that you ought to research and learn more about. If you're buying office space, look at the parking available, because that's going to be a consideration which I'll cover in a very short while. Right now, I think it's a good opportunity to look at commercial conversion, simply because a lot of people, as you know, are working from home because of lockdown rules. When the new normal comes in, whenever that is, it's anticipated, expected that more people will continue working from home. Therefore, less businesses will require commercial space. Therefore, they'll look to sell their offices if they own them, or if they are renting them, they may look to cease or exit from their lease arrangements, which means the owners may then either convert them themselves, try and find a new tenant, or they might sell them or sell their property. And if they're looking to sell their property, you could buy it and look at converting that into a residential conversion. So there are opportunities there. Then you've got obviously Rightmove, you've got so many other websites, Zoopla, there's more than I can cover here right now. And then you've got auction sites which you can look at. All of those will give you plenty of opportunity to look at properties, especially obviously commercial properties. With that, what the kind of big or quick and benefit is that you've got permitted development rights. So these are certain types of developments which qualify for permitted development, which means you don't need planning permission, or you don't have to go through the full planning permission as you do with other types of property. So you have to meet certain criteria in order to qualify for permitted development. and it'd be good for you to spend some time on learning that, so that you know exactly what you're talking about, rather than relying on the interpretation of the planning department in any particular local authority. And how it works in a nutshell is you submit a notice to the council with 56 days prior warning before doing any work. When I say warning, I mean giving them notice about any works you intend to do. They'll then have a look at the permitted development rights application, and they'll then come back to you with any questions. They can't stop you from developing it, but if you, for example, if you don't have enough car parking space, they can then restrict how many flats or apartments that you have, and it is sometimes getting stricter, so you just got to make sure that you've done your homework before you buy, to make sure that PD rights apply, and that you've spoken to a planning consultant who can assist you with this, because it can sometimes get tricky. And then if you're buying in an area which is an area of, say, outstanding natural beauty, or a heritage site, or a conservation area sometimes, and this, it kind of falls under the Article 4 direction, that makes it difficult and it's going to be problematic. So you want to make sure you check all of that out before you actually buy the property. You can speak to the agent if you're buying through an agent, but it's money well spent to have your own planning consultant who can advise and guide you. Once you've done that, you're pretty sure that PD rights apply, you buy the property, and well, you could get the previous, or the person selling to you, to enter into an option agreement, and then you could do PD rights if you wanted to. You could do like a pre-app to find out more information about it, or you can just buy it and then go through PD rights with your planning consultant. That's something you can decide on as and when you're looking to do your next purchase or your first purchase. Next, funding. So here you need to do an appraisal, work out what the GDV is, so the gross development value if you're new to this, and then work out your figures in terms of your costs per square foot or per square meter to develop. That's going to be important to know the internal area that you can develop. Once you've done that, you work out your figures, your margins. In there, if you have a proper appraisal sheet, you'll have all your costs, you'll have your contingency, you'll have your interest costs. You can then approach lenders and get them to fund part of your purchase, and then also fund your development, or you could fund the development or the purchase of the development or the property yourself, and then get a third-party lender to fund the development costs, or you can get private funding from an individual or a company for the purchase, and then they would also look to fund the development. So there's different alternatives. You can go to some of the high street banks. Lloyd seem to have a good appetite for this. NatWest seem quite keen on it too, depending on the actual development. Then you've got Aldermore, you've got Shawbrook who will look at it. There's quite a few different lenders who are open to this type of development. And then obviously the lenders will look at your experience. If you don't have any experience as a developer or as a commercial conversion expert, then you might want to do a couple of JVs with people who've done these before, so that you can build some experience and expertise, which is going to help you with a number of things. One is obviously with the funding. Secondly, to start to understand how these projects work. Third, to find opportunities. Fourth, when you find opportunities, to go in there to see what the property is worth at the end in terms of the GDV value. 5, you'll start looking at car parking space, amenities, just a location. 6, you're quickly trying to be able to figure out how many flats or apartments you can get in there. So there's quite a few things that you need to learn alongside obviously working with building contractors, which can be challenging, which I'm going to move on to next. So when you're choosing your contractor, I'd say work with one who has worked on commercial conversions before, because the last thing you want to do is get somebody who hasn't done this before, get stuck with the job. You haven't got the time, and if you've got bank funding or third-party funding, the interest is going to accrue. It's going to be a nightmare. So go with somebody who's done this before, so that they've got the experience. They can guide you. There's certain things you might miss out, especially if you're new. They'll be able to help you with that. You can ask for references, see their quality of work, ask them about their particular methodology, so you can have a good understanding and compare like-for-like quotes, get 3 to 5 quotes, and then work out the one that works best for you. Then because you're doing a conversion and you're increasing the number of units, you will pay 5% VAT for the labour costs, and rather than 20%. And if you are subcontracting the labor plus the materials, then you'll pay 5% on the materials too. If, however, you want to buy the materials directly because you think you can buy them cheaper then from merchants, then you'll have to pay 20% VAT on that. So it might work out better for you to subcontract the labor and the materials. That's a calculation you can do and work it out. Then finally, for this video, should you keep or sell? Well, that depends. If you sell, you're going to obviously see the profit straight away, but then let's say if you bought it through a limited company, you'll have to pay 19% corporation tax. Then you've got the rest of the 81% of the profit remaining. If you're looking to take some of that money personally, then you'll have to pay income tax on a salary or a dividend. If you're looking to obviously to recycle the whole lot into your next deal, that then begs the question, why would you want to sell? And there are reasons why you want to. You might have investors involved, you might have the bank involved, and you can't get you can't refinance it. You want to sell the properties and pay the bank off. But generally, if you haven't got any problems with the investors or the bank, I'd say refinance. Don't sell the properties, put all your money out, and sometimes you can get some extra on top. I've got some videos on this channel where I've talked about that to you and how I've done it. I'm just about finishing off the New England project, which you can see the videos. In fact, click this link here and you can see some of the videos, and I'll talk you through the refinancing once that goes through. So you refinance it, put all your money out, pay the bank, pay the investors, you get hold of the property, you've got all your cash back, and let's say you've done a commercial conversion with 6 flats. So 6 flats, all your money out, interest costs paid, everything paid. Those 6 flats cost you nothing. They're earning you rental income. You get a new mortgage. The mortgage is being paid through the rental income. It will create some extra cash flow for you as well, hopefully. Why would you want to sell? That's why I don't sell them, I hold on to them. But there are other people who are experienced in this particular field. Some of them don't want to hold, they want to sell. So do whichever one works for you best, and keep me posted. Any questions, post them in the comments below. If you like the video, click like so I know this is the type of content you want, and click subscribe so we can keep you updated with all the regular content.